So I'm going to start by talking about the changes that mostly apply to individuals. Hopefully that's of interest to everyone in here. The way I could summarize all the individual tax changes is to say the IRS has taken away a number of deductions but given us a lower tax rate. You know, essentially they're going to be collecting a bigger, smaller slice of what's hopefully a bigger pie for them. And that's kind of a trend that you've seen in state taxation for a number of years, with Maine too getting rid of its itemized deductions and personal exemptions through phase-out, things like that, while at the same time lowering the tax rate. That's essentially what the IRS has done. So the first thing I'm going to caution you on is, everyone's probably heard by now about the loss of the state and local tax deduction. That even made it onto the regular news. You know, the nightly news was doing stories about people at the end of the year trying to prepay property taxes and things like that. What we're recommending to people is the first thing you should do is probably review your itemized deductions, assume that the 2018 law applies, and figure out, does it even make sense to you to itemize anymore? That's really going to drive a lot of the decisions you're going to make over the next year about how you spend your money. And then the final thing to start off with is the window for gifting is open. Since 2001, the exemption has gone up from $1 million all the way to $5.6 million, with a couple of fits and starts and maybe debates about whether it would be extended. But we've now got at least a 7-year window where the estate tax and gift tax exemption is doubled from 5.6 to 11.2 million, with the caveat that there could be something called clawback that we've dealt with before. At least we plan to deal with it. And I'll explain to you what that is, but still, I think a pretty good opportunity for a lot of people who may have been waiting for something just like this. So, like I said, the estate and gift tax exemption is doubled. That's excellent. It's a greater opportunity to make tax-free gifts. The trade-off, of course, is always making tax-free gifts. The donor gives the recipient the basis, and the recipient takes the carryover basis. So you really have to consider you're giving up an income tax benefit, potentially, for the recipient. When they sell the property, they're going to be paying higher taxes. So what's going to happen this year, in addition to that consideration, we've got kind of this new twist of the estate and gift tax exemption after the law change, maybe higher in the year of the person, maybe higher now than it is eventually in the year of the donor's death. The reason for that is the estate tax is calculated using the exemption that's in effect in the year you die. The gift tax exemption is in effect for the year you make the gift. It's conceivable, I guess, that someone could give away their entire fortune, die sometime after 2026, and owe estate tax with no remaining assets. I don't know what the IRS would do in that case, but kind of be curious to find out.
Volunteers.
to die or to give? Neither one's necessary. No, but that's kind of an interesting thing. I know from talking to people already, people are very interested about the possibility of gifting. I think the things you've got to weigh are, what do you think is going to happen with the law? I was reading one newsletter that talked in 2012, I think was the last year we were faced with kind of a reduction in the gifting exclusion, and they talked a lot about sort of gifter's remorse when people rush to make a gift right before the exemption dropped. And I think that's probably an area where non-tax considerations are ultimately going to control. People need to be very comfortable that they're going to be able to part with the assets and not rush to make a tax-motivated gift. But but certainly the answer is going to be different for everybody. Just a note about Maine estate tax planning in Maine. Maine has not conformed to these changes. They still use the exemptions that were in effect in 2016, the old 5.6 million per person. And Maine has also not adopted something called portability, which is essentially the ability of married couples to share that 5.6 million deduction in a very easy way. In Maine, it's probably still necessary to use trusts and things like that and divide up ownership of assets, which you can do. But that's still necessary under the new law. And I have no indication yet if Maine's going to change the law to conform to this. I don't know if anyone else has heard anything. Probably won't know for quite a while. Probably the takeaway is it's time to get the estate plans out of the drawer and dust them off and take a fresh look at them and see if they're still accomplishing your goals and if they need any kind of revision. So next, new tax rates, generally good for everybody. I'm not going to go over this in too much detail because you've all got these in your handouts. What I kind of wanted to show with this is maybe just the dollar change is what I think is interesting. You're sort of, it doesn't look to me like you're saving a tremendous amount of money here. And then especially with the trade-off of losing a lot of itemized deductions. I'm kind of questioning whether this is going to be a good thing for a lot of people. Certainly when you're up in these brackets, you're going to be great, but I think for people in this income range, it's going to be a wash, potentially. Another thing that I thought was kind of interesting is what they did with the capital gains rates. We have 3 different capital gains rates that could apply, 0, 15, or 20. Under the old law, once you're in the highest tax bracket, your 15% tax rate kicked up to 20. Well, they've expanded greatly the tax brackets, but not when it comes to capital gains. So that 20% kicks in much earlier and kind of hits people who are starting to, be to the tail end of the middle class. And this is going to be done on individual returns. The big change here is we used to get, a personal exemption, a dependency exemption for taxpayer spouse and each child we had or other relative. They've done away with that and replaced it with a standard deduction that's the same for all filing statuses, regardless of the number of kids you actually have. So there's going to be winners and losers there, I guess. Probably what I would do is start to, again, when your 2017 return is ready, start to compare what you're getting under the new law to what you have under the old law, and see if you're coming out ahead. Itemized deductions is another area where, again, because the state and local tax deduction going away made a lot of news and a rush to prepay. A lot of people have started to think about this. I think the exercise for most taxpayers is to, again, do your best estimate of what you're going to have for 2018 deductions, and if it's even going to make sense for you to itemize. Mortgage interest for most people is going to be unaffected. It's going to be grandfathered in on old loans. Home equity and loan interest is what's going away. So I think over the next 11 and a half months, you need to think if you have a home equity loan, should you consider paying that off? Are there other things you can do with the money now that you're not going to be getting it at that after-tax rate? We've kind of looked at some options, and I think you're fairly limited. The rules for refinancing mortgage debt are such that your principal balance goes down over time. So you can refinance, and you can still deduct, but only up to the balance that you had at the time of refinance, not the original acquisition cost. So I've already fielded a few questions of, well, can I take out, can I refinance my mortgage instead of getting a home equity loan? And the answer is no. If you borrow more than, the current balance at the time, it's still considered a home equity loan. Even if your loan balance is over $750,000, though, you probably will still be able to refinance it as long as you stay under that $1 million mark. Last time they did anything with this was 1987, and I think that was the rule at the time, is that they did grandfather all that old debt. Miscellaneous itemized deductions have gone away too. That would be things like your tax prep fees, your investment advisory fees. So if you were doing things like paying your IRA fees outside of the account to get the deduction, it's probably not necessary. It's probably not a benefit to doing that anymore. Maybe there's a benefit for investment purposes, but not tax purposes. So I'm not sure if that's something that people are still recommending. The other big one is charitable contributions. That's kind of its own section of this tax act, and we did have questions about sort of what's the impact on charitable giving. The short answer I'll give you now is nothing the IRS has done is likely to help charities. There's a couple of ideas we have to get around that, but as you're I guess as you're planning for 2018's contributions, there's a number of things we're going to recommend you do differently. As far as other deductions that we're losing, the main thing I wanted to bring up is the alimony deduction. Hopefully it doesn't apply to anyone in this room this year. But starting with 2018, we're going to lose the person paying the alimony previously took that as a deduction. The spouse receiving the alimony picked it up as income. They are reversing that and saying that there's no longer a deduction. I guess they're thinking the spouse with the ability to pay is probably going to be in a higher tax rate, and therefore that's the better person for that to tax. But you have until the end of this year to finalize your divorce agreements. Definitely keep that in mind. On behalf of your clients. Tax. Did this microphone just come on? Child tax credit. This is what finally got Marco Rubio's vote for the bill. It's doubled. It's still subject to phase-out limitations, so not actually tremendously helpful once you're up in the higher income brackets, but still a nice deduction. So those were the things I sort of had that covered individual tax. I'm happy to take questions on any of those subjects now because we're sort of moving on to the business and pass-through entity section. Yeah?
What are the thresholds on A and T?
So, good question. I had tried to avoid talking about A&T because I find it's a subject that makes a lot of heads spin. But what I'll say is essentially the IRS has made the regular tax a lot more like the alternative minimum tax. For those of you who don't know, the AMT is a separate tax calculation parallel to your regular return. They tax you at a lower rate, and they take away a lot of deductions like the state tax deduction and your personal exemptions and your miscellaneous itemized deductions. And kind of like they're doing now, apply a lower rate to a higher base. So, essentially they've put everyone in A&T by doing this. Now, there still is an alternative minimum tax, but they have raised the exemptions. The income thresholds for your A&T exemption would phase out. It used to be very low. They weren't indexed for inflation previously. They've kind of corrected that by bumping those up significantly. So it's likely that fewer people are going to be in A&T, but I think that's more because no more state tax deduction, no more personal exemptions, no more miscellaneous itemized deductions, which are the big three things that throw people in there anyway. Certainly still could apply, but I don't think it's going to be a planning consideration the way it was for us for the last several years, where we were always worried about getting that last tax payment before the end of the year to maximize your deductions. So I don't know the exact numbers. I'd be happy to provide them for you, but that's kind of why I left out AMT. Is I guess the best way to say is they've kind of neutered it, and it's only going to be people with more exotic deductions that are really going to be subject to it. That was a good question. Anything else?
You mentioned that to refinance your house and take out new money, the new interest on the new money isn't deductible.
Yeah.
If I understood it, what if you're doing an addition or some other improvement to your house?
So that would be fine. They've taken out the home equity loan, but you've still got the ability to do mortgages, and as far as I can tell, you've still got the ability to do second mortgages. So if you were going to take out a home equity loan and you were going to buy, build, and improve your residence, you'd still be fine. You just have to make sure that loan is structured as a second mortgage versus home equity. And I assume the bankers, perhaps it was easier to get a home equity loan or something like that, and that was the reason you more commonly did that for home improvements versus a second mortgage. I think that's probably the only thing you need to do. It's people who take out the home equity loan to buy a car, or perhaps some other personal item that are really going to be, really going to be losing out here. But yeah, I think that would be fine. If you're going to build a garage or put an addition on your house, you can take out a second mortgage. As long as you stay within the new limits, you'll be fine. And I assume at some point they'll come up with rules about if you fall into the old $1 million limit, and you take out additional loans, how do you calculate it? That's something we'll get guidance on. But yeah, second mortgage I think should work just fine. Oh.
Did I hear you correctly that you said that the child exemption is no longer because of the state deduction?
Yeah, that's right. If you were taking the approximately $4,150 per year per kid, in addition to the taxpayer and the spouse, that's gone away.
So if you have a couple that's not married and filed separately, it won't really matter from the claim?
In that situation, you know, I guess in the case of an unmarried couple with a couple of kids together, it's really going to depend on the custody situation, because in that circumstance, one or both of them might be able to do head of household. You know, it all depends who gets to claim the kid and who provides more than half of their support. So I don't know what they'll do in that situation, other than just, you know, pick the appropriate filing status, single or head of household, and depending if the kid lives with you, and then you'll take the combined standard deduction. That's kind of all you get. But yeah, I think for married people, you get 2.5, the equivalent increase of 2.5 exemptions. So I guess that's only half a kid. So yeah, it at least seems to me like you're getting less, but to kind of bring it back to your question, personal exemptions were also not included in the A&T calc, so a lot of people weren't getting the benefit of them anyway. And you maybe just wouldn't know it unless you sat down with your CPA and took a really close look at your 1040, which I find most people don't want to do. I don't take that personally.